Hello, everyone. We're excited to talk to you all about tender offers today. We're going to just hold off for another minute or two and let the rest of the crowd trickle in, and then we'll dive into our presentation today. Right. All right. Well, I think we can get started. Welcome. Really excited to speak to you all on tender offers today. For some quick background, my name is Moreno. I'm the co-founder and chief tax officer of Fifteenth. Fifteenth is a modern tech-forward tax firm for individuals in the tech space. I also have Jason Hoffman, who's joining us, one of our tax advisors, and we'll be jumping right into the content. We're going to be talking about tender offers, what it means for you on the tax side. We'll be talking about how 15th can help, and then we'll be opening the floor for any questions you all may have, and trying to help you navigate this what can be a tricky transaction. All right, well, Jason, I'll let you take it away.
All right, thank you. So first and most importantly, what is a tender offer? So a tender offer is essentially when someone offers to buy shares from shareholders at a set price within a limited time frame. Most of the time, this is something that a company is organizing for their current employees, sometimes including prior employees, but this is arranged by the company, and it is an offer to sell shares at a set price for a specified amount of time. Now, when it comes to tender offers, they can be a bit tricky. And so one of the first and most important things to be aware of is tender offers can be one of two things. They can be considered non-compensatory or compensatory. And that's going to be really important, especially when we zoom out and we look at tax treatment. So a non-compensatory tender offer is essentially where the sale is treated as an investment. So it's like you're holding, normal stock and you're selling that stock, and it can result in a capital gain. And then you would have capital gains tax rates applied to that capital gain. Now, a tender offer can also be what's referred to as compensatory. And this is essentially where, in the eyes of the IRS, the sale is treated as compensation, and it's subject to ordinary income tax. Now, this is something where you might say, wait a minute, if I hold options and I bought them and they became shares and then I sold them, wouldn't it be a capital gain? This is where tender offers can be tricky. And that's why it's really important to be aware of what kind of tender offer it is before you participate. And this is commonly why it's really good to have a tax advisor who can kind of take a look at this and walk you through and make sure that you are fully aware of all of the implications. Now, in our presentation today, we're primarily going to focus on non-compensatory tender offers. They're a little bit more cut and dry and straightforward. Compensatory offers, as I mentioned, they can be very nuanced. So it's kind of hard to specifically dive in and present on them just because they are very, very different one from the other. So non-compensatory, we'll dive into that, and we will take a look at the specific implications that you may face if you decide to participate in a non-compensatory tender offer. Now, a few important things to note related to tender offers. Tender offers have a specific window. The sale window is open for a maximum of 20 business days. And this is something that is kind of set in stone. And there are some very specific rules and reasons as to why it's 20 days, which we won't get into. But just note that that's why tender offers have a very specific window. Now, another important thing to pay attention to is going to be something called the offer to purchase. And this is probably going to be the most important thing, or one of the most important things to pay attention to in relation to the tender offer. This is a legal document that outlines the transaction details and important deadlines related to the transaction. So, when does the offer open? When does the window close? It's also going to indicate tax treatment. So when I mentioned compensatory versus non-compensatory, the offer to purchase is what we're going to look to ultimately figure out how is the offer being treated. Are there any other nuances that can come with the offer? Sometimes there can be. The other big thing that you'll want to note is getting tax assistance. So getting help understanding the transaction and figuring out how the transaction is going to impact you from a tax perspective. They're like snowflakes. It's a really good analogy to use. Every tender offer is different and can have its own nuances. I have even seen cases where a company will have multiple tender offers in the same tax year and they are treated differently, which sounds crazy, but it is something that very commonly happens. So that's why it's so important that you talk with a tax advisor and have a good understanding of how the tender offer is going to impact you. The other thing to note is it's probably good to make sure your tax advisor is also familiar with tender offers, because there are instances where a tax advisor might not be, and they might just assume, oh, it's going to be capital gains tax treatment, when in reality it's not. You need to look at that offer to purchase. So these are a few important kind of notes and housekeeping items to be aware of if you are going to participate in a tender offer. Now, when you have a tender offer, there are usually a few different ways that you're able to participate. Again, this is where it's really important to reference that offer to purchase, because it's going to specifically outline how you can participate. But the three ways that you're most likely going to be able to participate are going to be, first, something called a cashless exercise. This is basically where you simultaneously exercise and sell shares. So you have options that are exercised and then they're immediately sold. The exercise price in this case is netted against the sales proceeds. And the exercise is also contingent on the tender offer, meaning the exercise doesn't happen unless the tender offer closes. So it's kind of an all-in-one situation. You don't have to put any cash down up front. It just all happens at the end when the offer closes. The other way you can participate is something called an exercise and sell. And this isn't something that you're able to do in every tender offer. This is something where we definitely would need to read through the offer to purchase and see if this is allowed. But this is where during the tender offer window, you are able to exercise your options. So you use your own cash, you exercise your options prior to the tender offer closing. Those options become shares, and then you turn around and you sell those shares in the tender offer. Now, the big thing to note here is the exercise is not contingent on the tender offer closing, meaning if you exercise with your own cash and for whatever reason the offer doesn't close, you're holding on to those shares. Those options have been exercised. You're going to pay tax on that exercise, and those shares are now yours. So that's a big kind of distinction between cashless exercise and exercise and sell. Lastly, the other thing that you can do is you can sell shares. So this is basically where before the tender offer kicked off, you have options, you exercised them, and now you are selling those in tender offer. But those are, generally speaking, the three ways that you can participate. And now I'll hand it off to Laura, who's going to walk through some specific examples.
Thanks, Jason. So let's dive in. Jason's done a really great job giving us a high level overview of these different ways that you can participate. Now let's dive into each one and get a bit more granular on what they mean from a tax and a cash perspective. So as Jason noted, this first way to participate in a tender offer is called a cashless exercise, and you are simultaneously exercising and selling your shares. In terms of what this would look like from a tax perspective, the full spread between the sales price and your exercise price would be treated as wages. So because it's treated as wages in this scenario, it would be subject to payroll taxes and income tax withholdings. Now, I'm going to fast forward to the end of this slide, which notes that the withholdings may not be sufficient here. So one of the most common observations I hear from clients are, well, I had my employer withhold, and I saw about 45% come out. 45% is not going to any one jurisdiction. 22% is going to go to federal. If you live in California, another 10 will go to California. And then you have Medicare and Social Security coming out. And it gives you this false sense of comfort that you have a lot going to the IRS or California, when in reality, it might not be enough, especially zooming in on the IRS portion. And it's just something to look out for in terms of talking to a tax advisor and making sure that this withholding is actually covering the related tax. And then from a cash perspective, you'll be getting your sales proceeds net a couple things. One, your sales proceeds will be lowered by your exercise price. It will be lowered by the Medicare, the Social Security that's coming out, as well as any income tax withholdings from a federal and a state level. From a cash, to the extent that you have not exercised any options going into a tender offer, this is one way that you can participate. Individuals that like to not to have some sort of withholding in the bank usually like this, and they're like, well, yeah, I just want something to come out. I don't want to have to worry about setting too much aside for taxes. It's usually more of a convenience thing. And then just to give an example, let's say there was a tender offer and the sales price was $10. Let's say this employee's exercise price was $1 and they hadn't exercised anything previously. Should they wish to exercise this full spread between the $10 and the $1 would be wages subject to payroll taxes and withholdings. So that's option number one, which is applicable to stock options. The exercise and sell is going to be specific to ISOs. That's what we're reviewing right now. So essentially, in this participation method, employers may give employees the ability to exercise and then sell the shares during the tender offer window. I want to emphasize may, because it is definitely not required that employers provide this. We do see most employers provide this, but again, something to look into the purchase documents that Jason mentioned earlier, the offer to purchase. So going back to exercise and selling, this is a bit different from the cashless exercise in that you are exercising, you're putting the cash down, and then you're selling the shares. So from a tax perspective, why would someone want to do this? And the treatment is a bit different and might save you a bit of taxes. So from a tax perspective, the spread between the fair market value at exercise and your exercise price is treated as wages, but it is not subject to payroll taxes. So you might be saving on Social Security and Medicare if you were to take this route. The spread between the fair market value exercise and the sales price would be treated as short-term capital gains. It's really important to nail down the fair market value at exercise. Some companies have a fair market value that they're using during the tender offer window. Some companies believe that the fair market value is equal to the sales price. So again, it's one of these gray areas where companies have to make a decision, and we've seen companies do either one. So really the savings here on the exercise and sell are these payroll taxes that you can save on. From a cash perspective, you would also be getting more in your pocket now because there are no withholdings. So for those employees that want to optimize for getting as much cash as possible now and not prepaying the IRS or state taxing authorities now, this might be a good route to take. Now, you would be getting at settlement all your sales proceeds for those shares sold, but it's really important that on the exercise date, you would have to upfront the cash for that exercise. And it wouldn't be until 20 business days plus that you would be getting your sales proceeds. So there is going to be a time element here and that you have to put the cash up front. So I guess it's that's something to weigh out, are the Medicare and Social Security savings worth you upfronting the cash? Is that something that you have available? Again, I'm always going to plug the tax advisor, especially in this situation. There are no withholdings. You will need to set aside an amount of cash for taxes on this transaction. So it's really going to be important to meet with someone and make sure you have an understanding of what that is, so that you can, make those decisions on where to put that money. So going back to our example, let's say the sales price is still $10, the exercise price is $1, but let's say that during the tender offer window, the company determines that the fair market value is $5. If we look at here, the spread between the $5 and the $1 will be treated as wages, no withholdings. And then the spread between the $10 and the $5 would be treated as a capital gain, short-term capital gain. And then if we go into this last example here, this is really going to come into play to the extent that you previously exercised options, and now you're going into the tender offer window with shares that you are eligible to sell. And to the extent that you've held these shares, if you have incentive stock options and you've held the shares for at least 1 year after exercise or 2 years after grant, this is going to produce a long-term capital gain, which will be taxed at lesser rates compared to the first two options that we talked about. So in terms of tax efficiency, if you're looking to pay the least amount of taxes, this would be it. If you had previously exercised non-qualified stock options, then you would only have to hold those shares for 1 year. Now, the one really important note that I want to make with selling shares, especially for employees of private companies, it's really going to be important to follow up with your employer on whether those shares you hold are eligible as qualified small business stock. Why that's important is that if you are holding shares that are considered, let's use the acronym QSBS, if you hold on to those shares for 5 years and then sell, from a federal perspective, that gain would not be taxed up to the first 10 million. On a state perspective, it depends on the state as to whether you would get that benefit or not. We have run into some employees that are participating in the tender. They have no idea about QSBS, and they're on year 4 of their holding period. And, once we talk to them and we explain this, they're like, oh my gosh, I don't want to touch these. I would rather bank in the 5 years and hold off. So that's really an important nuance here. If you exercised early and you're holding those shares and the company was considered a qualified small business at the issuance of those shares, you might not want to touch them until you get to the 5-year mark. So important side note. So from a tax perspective, we talked about, long-term capital gains here. And hey, maybe you reach the 5-year holding mark and then maybe this is 0 for federal purposes. From a cash perspective, at settlement, you will receive all the proceeds. You're not having anything netted out. But again, this is considered a transaction that has no withholdings. There's nothing us being sent to the government here. And why that's important is because you want to just have an idea of how much of those proceeds you need to set aside for taxes. So that's not a surprise come April next year. So if we go to our example here, again, assuming that you're hitting these holding requirements of either 2 years after grant and 1 year after exercise for incentive stock options, or 1 year for non-qualified stock options, the whole spread would be considered a long-term capital gain, which of course is subject to lower tax rates than the first two participation methods that we discussed. In terms of the takeaways, reviewing the ways that you can participate, there are different tax implications here. and different pros and cons as to, you know, which method you want to take. So it's really important to understand what options are available to you and what's important in your decision-making process. I always, everyone knows that I say this expression all the time, the tax tail doesn't wag the dog. Participating in a tender may not always be tax efficient. To be honest, I usually have a lot of clients that come to us and they're like, wow, I can't believe how much in taxes I paid. But again, taxes might not be the driver of you participating in the tender. Maybe you want to diversify. Maybe you want a bit more cash flow. We understand that from employees at private companies might not always have the ability to sell, right? And this does provide some liquidity. And of course, lastly, please talk to a tax professional. We have seen, you know, I think there are two parts to talking to a tax professional. The first is going to be talking to a tax professional at the time of the transaction and really getting clear on what is the best route forward, depending on what feels most important to you. The next piece of talking to a tax professional is at reporting. Reporting for the tender offers can be very complex. You could be getting multiple tax forms that are reporting the same gain. And unless you understand the adjustments that need to take place, you could be essentially paying taxes twice. And we've seen many employees do this because you're getting forms that feel familiar. You're getting, some of it's in a W-2 and some of it's in a 1099-B. And many of you receive these 1099s through brokerage accounts that you hold. But it's really important to talk to a tax advisor when you're reporting. We've seen a lot of individuals make errors here, and it could be a meaningful amount of money that's coming back into your pocket if you have a tax professional report for you. So really important to talk to someone while you're going through the transaction, as well as when you're reporting it on your tax return. In terms of how we can help, well, we are a modern tech-forward tax firm, specifically focused on individual tax services for tech employees, tech founders, tech execs, VCs, investors. Equity compensation is our bread and butter. So we work with a lot of our clients on tax planning around these elements, as well as filing of tax returns. So we do offer one flat fee, and that flat fee includes the preparation of your tax returns. It includes access to our platform that is creating amazing customer experience, as well as tax advisory. So most CPAs will charge hourly for tax advisory, and tax advisors already included in our flat fee. So if you're interested in learning more about how we work with clients or the kind of scenario planning that we work on with tender offers, on our website, 15th.com, you can click on Talk to an Expert, and this will route you directly into our sales process, where you can learn a bit more about our services and get a feel for you know, what your flat fee would be, which is dependent on complexity and volume of tax documents. Great. Well, this is where we are going to open up for questions.
And we already have a few questions. There were a few people who submitted ahead of time. And then if you have questions now, feel free to use the Q&A feature and drop your questions and we will answer. I will take the first question that we have, which is it stated in the offer to purchase if the tender offer is compensatory, or is this subject to IRS determination afterwards? And the answer to this is both can be true. So the offer to purchase will state if the transaction is compensatory or not. It won't necessarily clearly say that. There will be a number of things that kind of hint to, okay, this is being treated as compensatory or non-compensatory. The other thing that the offer to purchase almost always says is that if the IRS looks at the offer in the future, so for whatever reason, if they decide to the company or the offer as an individual taxpayer, they could very well look through everything and look at the facts and circumstances and say, hey, we don't agree with how this is being treated, and we actually think it's compensatory or non-compensatory. Now, what I will say is most of the time, the legal teams who are writing the offer to purchase, they have good reason to take one stance versus the other, and they have looked at tax law and whatnot. But in summary, offer to purchase will state compensatory or not based on how it says the transaction is being taxed, but the IRS can always come in and disagree with the determination in that, which I would say is probably a pretty rare situation, but definitely something that can happen. And then we have one other question that's a follow-up to that, which is, during a cashless exercise, if it is non-compensatory, would it still be treated as wages with payroll or income tax, or would it be treated as capital gains? So cashless with non-qualified stock options is always going to be treated as wage income, just because of the nature of how non-qualified stock options are treated. Now, with incentive stock options, it's a little more nuanced, and this is where we will want to look to the offer to purchase. Most of the time, what we see is that if you do cashless with incentive stock options, they lose their status as incentive stock options, and for tax purposes, they're treated as non-qualified stock options. Now, it's not this way 100% of the time. There are times when it's not that way, but most of the time, if you do cashless with ISOs, you will see that they lose that status, and it's all just ordinary income tax that you're subject to.
Awesome. I'm seeing another question. Yikes. My company is private and had a tender offer period that just expired yesterday. Are there still things I can do to save me on taxes? This is a really great question. So the important thing to note is if you participated in a tender offer, you can't edit the sale that you put in. However, we're in 2025. So this is the time to meet with your tax advisor and start planning. There are definitely levers that you can pull between now and 12/31 to figure out how you can reduce your tax bill, as well as have some transparency on what that potential tax bill could be. So certainly you don't need to take action during the tender offer period to reduce taxes. You have until the end of the year to do that.
And you can also, a tender offer is a great opportunity to say, hey, I have this influx of cash that I received from my company equity. How can I use that cash to set myself up to be in a better position in the future, such as, does it make sense to exercise more options this year, or should I hold off? There's so many different things that you can do. So just one little addition there that can be really helpful. It's a great year to look at potentially exercising some additional options potentially.
Yeah, great point.
We have another question. How does a tender offer differ from a secondary sale? So a secondary sale, I think technically they could be called the same thing. But I would say a secondary sale where we see this is truly a secondary sale and it's not a tender offer. A secondary sale can be between just an employee and an outside investor if a company is willing to approve a transaction like that. It can also be just between a very small group of employees. So maybe the executives or only people who have been there for a really long time or something. It's usually a situation where there's not a whole offer to purchase. It's they have shares, they are selling those shares to an outside investor, and it's truly just a sale. A tender offer is where there's an actual legal document written up. There's 20 days for the transaction to happen. And there is very specific criteria on this is open to everyone at the company that meets X, Y, or Z requirements. So I'd say that's the big difference between the two. Let's see. Our next question is, my income for this year is going to be significantly larger than previous years due to a tender offer. What safe harbor rules could apply to me? So great question. In your case, since your income is going to be larger this year than it was last year, we're likely going to want to make sure that you have paid in at least 110% of the tax that you owed or that you paid in 2024. because that will safe harbor you. So the safe harbor rules are either 110% of your prior year or 90% of your current year. It's the lower of the two. And so the lower for you is likely going to be 110% of prior year, which is what we would look to make sure that you have paid in so that you're not hit with any underpayment penalties. If there were any taxes withheld from that tender offer, there's a good chance that you have potentially hit that 110% threshold. We'd want to look to 100% confirm. If there's no tax withholding, then it's likely that you would want to start making some estimated tax payments or work with a tax professional to figure that out.
The one asterisk I will put in there is just for California residents.
Yes.
If your income is over $1 million, California says that you cannot rely on safe harbor rules. And we have a lot of clients in California, and I'm assuming if you guys are on this presentation, a good number of you are also in California. So just something to note, you can still rely on safe harbor for that for federal obligations, but for California, you might have to work with your tax advisor to come up with an estimate. Awesome. I'm seeing another question. If I'm selling shares, when are my taxes due? Which is actually something similar to the question that Jason just asked now, or, that we had a client ask. And I think, when it comes to non-wage income, we are going to run into, like selling your shares, we're going to run into potential obligations or payments that are due throughout the year. There's no withholding here. As you get paid your wages, a part of your wages are coming out and being sent to the IRS and state taxing authorities. Whereas when you're selling your shares and realizing a gain, nothing is going to the IRS or to the state. And this is, again, where you may have to remit quarterly tax payments throughout the year. There are different ways to calculate that. Sometimes I've had clients come to us and say, yeah, I already calculated, I already paid in actuals. I actually calculated what the gain was and the related tax, and I already paid it in. And they're basically prepaying tax that they don't need to pay in because they were just unaware of the safe harbor rules. So this is why it's important to talk to a tax advisor so that we can really lay out the options that you have. So yes, when you sell shares, you could be subject to paying quarterly or throughout the year. The other, option I'll mention is that some of our clients would rather pay the underpayment penalty than make the quarterly tax payment. Penalty sounds like a strong word. It's an interest charge. You're paying an interest charge to the IRS and to the state for keeping your money. A lot of our clients want to keep their money where it is and they don't want to liquidate and send to the IRS. We'll just we'll show our clients what that number looks like so that they're aware and they might pass on it. So anyway, this is all to say, if you realize a gain, you might have something due throughout the year, talk to a tax advisor, ideally talk to us, and we can help you navigate what this looks like.
Our next question is, how are these tender offer tax considerations similar to the purchase and sale of shares acquired as part of a group of LPs? So I think this is asking, or this might be asking one of two things. If I acquired shares through investing in a limited partnership, and then I have the opportunity to sell them in something that's a tender offer or something like a tender offer, am I subject to similar tax rules? And the answer to that is yes. We would still look to the offer to purchase to figure out how you are going to be taxed. Now, if your question is more so geared at I acquired shares through investing in a limited partnership, and now I am going to turn around and sell them to somebody, then if it's not in a tender offer, you would end up having a capital gain. It'd be long or short term, depending on your holding period for those. And you wouldn't necessarily have to look at the same, is it compensatory? Is it not compensatory? What are all of these nuances associated with it? Our next question, this is a great one. If I don't trigger alternative minimum tax in the same year as the tender offer, can participating help me increase the amount of minimum tax credit that I can claim? If so, how? Yes, the answer to this is participating in the tender offer can potentially help you get more of your minimum tax credit back in the current year. There are a few ways that this can kind of come into play. The first way is if you have shares that you are holding that you sell in the tender offer, and those shares were derived from the exercise of incentive stock options in a prior tax year, then what happens when you sell those shares is you're going to get a basis adjustment on the alternative minimum tax calculation side of your tax return. And that is essentially going to help accelerate the amount of minimum tax credit that you get back. The way that it works is essentially you have two calculations running in your return. You've got your regular tax calculation and you've got that alternative minimum tax calculation. And basically the difference between the two is the amount of credit you can get back. So like if you've got 20K of regular tax and 15K of AMT, that 5K difference there, that is the amount of credit you can get back. Now, what happens if you sell incentive stock options from that were exercised in a prior year is that adjustment that you get on the AMT side, it's going to help drive your AMT down. So maybe your AMT would have been 15K. Now you have that adjustment and maybe it's 10K now. So now you've got 10K of credit that you can get back versus before you would have only gotten 5K back. The other way, and this is kind of a little more nuanced, but the other way this can really help you is sometimes if you have a higher amount of ordinary income tax, that can help accelerate the amount of credit you get back, because the higher that your regular tax is, the higher your regular tax rate is. So like the top bracket is 37%. So if you've had a lot of income, you're in that 37% bracket, you have a really high effective regular tax rate. You're going to get more credit back because the top alternative minimum tax bracket is 28%. It's a flat rate. And so basically, if you're having a lot of income, that ordinary income tax is going to increase and the AMT is going to like top out because it's only 28%. So that gap between them gets bigger, allowing you to get more credit back. Again, very nuanced, and try to make that as simplistic as possible, but it's definitely a situation where you want to work with a tax professional and do some modeling, because the way you participate can also impact the amount of credit that you get back, and maybe you do one over the other because of that. Let's see here. Oh, this is a good one. So this is a tricky one that we see a lot of people run into. And it is, I previously exercised my options when I was in California, and now I live in New York. So I moved. Do I need to pay California taxes on the gain? And there's a lot of nuance here. The one thing that I will kind of start out by saying is, if you sell shares and you have all capital gains, 100%, long-term or short-term capital gains, your capital gains typically follow you and are taxable to the state that you are a resident of when you recognize them. However, if you have options and you were granted some in, say, California, some of them vested in California, you have not exercised them yet, and then you move to New York and you choose to exercise them. In that case, then basically there's a ratio that applies of time spent in and out of the state and working days, and some of it's taxed back to California. Some of it will be, well, all of it will be taxed to New York. You'll get a credit on your New York return for the California tax paid. Becomes very, very tricky. I would also argue that, like, if you're at a public company and you have RSUs and you're like moving around, that's where it can also become even trickier. This is where you are going to get a ton of value from having a tax advisor who can do the allocations. Your company is likely going to try to do their own allocation, but there is a good chance that allocation is not correct, especially if it's a company that hasn't been it's not a public company, or they haven't been public for very long. They might not have a very well-established equity team that's great at reporting. So definitely a situation where you want a tax advisor to help you do that allocation, make sure that everything is reported correctly between the states.
Yeah, for sure. And I think the one thing I would add to the states as well is that, some public companies that have amazing systems in place completely rely on you accurately updating your address in the payroll system, which a lot of our clients are very busy or forget to update it, or they're not sure when is the right time to update it. So that might also create some reporting complexities on the tax side as well.
Yeah, great point. Our next question. Oh, go ahead.
Oh, yeah. I was just going to say, next question. If I exercise and sell ISOs in the transaction, do I need to worry about AMT? Which is a really great question. And in short, you do not need to worry about AMT. Of course, if we're talking about the same calendar year, right? So if you're exercising, let's say it's in a cashless transaction that we're talking about, if you were to exercise and sell immediately, you would not have to worry about AMT. It's really when you're exercising and holding that you need to make an AMT adjustment. So nothing needed on that side.
And the one pesky thing to kind of look out for there is if your company is offering exercise and sell, where like you exercise with your own cash and then you sell in the tender offer. If the offer is oversubscribed to and you're not able to sell 100% of what you have exercised, then you might be subject to AMT depending on how much you're stuck holding on to. So it's another good reason why you want to work with an advisor who can do some projections for you and kind of show you like what would the risk of that be, if you were stuck holding on to some of those. Another question is, what are some common nuances associated with tender offers? This is a good one. I would say there are so many different nuances. I would say one of the really, I guess it's not super common, but one of the things that I can see or that I see happen that sometimes people are really blindsided by is occasionally the offer to purchase will specify that if you do a cashless transaction with incentive stock options, the entire grant will then become non-qualified stock options, which isn't great. That's not a super common thing, but it's kind of like a gotcha that I've seen in the offer to purchase before. So definitely something to look out for. The other big thing is oversubscription. A lot of people might not realize that in a tender offer, the offer to purchase outlines a specific number of shares, or either number of shares or dollar amount that is like able to be sold. And so if a lot of times, like say everyone is allowed to sell 20% of their holdings, a lot of times if everyone does 20%, that is more than the offer to purchase outlines that could be purchased. So in that case, the offer to purchase will specify this, but a lot of times there's like a pro rata reduction. So like if it's oversubscribed by 110%, the amount everyone can sell is reduced by 10%. So that's another really common like thing to kind of be aware of. And that would be a situation where, hey, if I cash exercise and then I can't sell all of those, then you could be stuck with options that have triggered alternative minimum tax potentially. So there's a lot of little gotchas. I would say the other big nuance or the other big thing that I see happen with tender offers is sometimes companies, and actually pretty frequently, companies will not have a good understanding of the tender offer. So we will see situations where like a VP of finance or someone really high up at the company will give a general blanket statement about like how something should be treated for tax purposes. And it doesn't necessarily match what the offer to purchase says because these are really highly nuanced transactions. We also really commonly see this come tax filing time. When all of the tax documents come out, we will see that the reporting doesn't necessarily match up with what the offer to purchase says is supposed to happen. And so that's also a situation where like it's really valuable to have a tax advisor who can catch that and help correct the reporting and make sure that it's all done the proper way. Let's see here. Someone else asked, tender offers 20-day max or 20-day minimum window. I believe it is a 20-day maximum window. There are some other like nuanced implications that can happen if the window is open for more than 20 days. So 20 days is the maximum.
Yeah, and this is specifically related to ISOs. If you there are nuances here, but if you're offering individuals with ISOs that participate in this, I believe, I'm not an attorney, do not quote me, but I'm pretty sure the rule is that all the ISOs will convert to NSOs if you leave the window for longer than 20 days. So 20 days is the max. And I think maybe there is a nuance where you can keep it open for longer as long as ISO holders can't participate past that 20-day window. But again, very rarely do we see that because the majority of tech employees hold ISOs. and that's who employers want to participate in this transaction.
Yeah. And I would say it's more common to see a situation where, like, rather than trying to extend a tender offer, a company will shut down like current tender offer, and then later on, like, they'll open another one that's separate, to avoid issues with this. And that's where I said, mentioned earlier, that I've seen like multiple tender offers from the same company in the same year treated differently. This is like an instance where we could see that happen potentially. Another really common question that we get, that I saw someone asked, is there any kind of tax optimization that we can get from putting shares in an LLC or a trust? And unfortunately, the answer to that is no. So a very common misconception is that an LLC offers specific tax benefits. An LLC is just a legal structure, so it doesn't offer any kind of like tax benefit. The other thing to note too is, like, if you're talking about just transferring options, options themselves are non-transferable. And then if you exercise those options and they become shares, any kind of transfer is going to be subject to approval by the board. Now, the one way that maybe transferring some shares to a trust could make sense is if you hold shares that are qualified small business stock eligible. Then this is nuanced. There's something called QSBS stacking, where you can put shares in a trust, and then that trust gets its own $10 million QSBS exclusion. But big kind of important thing to note there is you want a tax professional and you want an estate planning attorney involved in doing that. And it's not necessarily going to be related to a tender offer. But in terms of like saving taxes for a tender offer on either of those items, there's not really anything that you can do. There's no benefit there. Go ahead.
Let's see. Next one. Is there a standard "Dude, read this now" webpage about the importance of getting QSBS eligibility documented early? I think that, is there a standard web page? No, there is not. And I think QSBS eligibility is one of those things that unfortunately, a lot of tech employees just don't know about. Even tech execs, it's something that comes up and that people are aware of once they speak to a tax advisor that knows equity. Even there are some individuals that have been working with CPAs for 5-10 years and still don't know what QSBS is, because their tax advisor is just not familiar with this space. So to answer the question, is there a Read This Now webpage? There isn't. This is QSBS eligibility, and getting that documented early is usually driven by a tax advisor that's giving a lot of great advice to their client. Now, in terms of how we work with clients, we definitely educate our clients in QSBS eligibility and give them a few avenues on providers that they can work with to determine QSBS eligibility. I think, our perspective is knowing whether you're QSBS eligible now is going to be a humongous benefit for you, your employees, the founders, your investors, because it is a really material tax benefit that you can lock in. I do know that some companies take the perspective of, hey, once we go public, we will look back and figure out when we lost eligibility. And I think it requires a lot of documentation and man hours to figure out where exactly did you lose it. If it's something that you're assessing every year, it's just going to lead to a lot less headaches later on down the road. So yeah, no standard place to look for QSBS eligibility, unfortunately. But if you are our clients, we're happy to educate you and help guide you on those decisions.
Our next question, and this is a great question as well, what kind of records should I keep to track my participation? So this is a good one, because come tax time, if you're working with a tax advisor, just giving them the 1099 or W-2 that shows the tender offer gain or ordinary income That's usually not going to be enough for us to decipher, was this compensatory, was it non-compensatory, what exactly did you do? So I would say a really good thing is, one, jot down how you participated in the offer. Did you do a cashless? Did you exercise and sell? Were they long-term shares? A lot of times there are option grant numbers or certificate numbers. Jot down, what you sold, which grant did it come from, or which lot of shares did it come from. Carta does a great job of tracking all of this. Keep a copy of the offer to purchase. That's going to be really, really important. And then if there's any kind of transaction confirmation that you get from the platform showing like what you submitted, that is also going to be something that you will want to keep track of. And then come actual tax filing time, if you have not already been working with a tax professional, so maybe you sign up to work with a tax professional in January and you participated all the way back in March of the prior year, you can always do a screen share with your tax professional and say, hey, here's a card account, here's all the information they did. It's really good to flag ahead of time that you participated in a tender offer or secondary sale. So like, don't wait to submit all of your documents and then not know like what your accountant is going to need. Flag it to them ahead of time. Send them an email. Say, hey, I participated in this tender offer or the secondary sale. I want you to be aware of it because I know there can be some nuance, and that will give them a really big heads up. It's also going to be great because believe it or not, we see a lot of mistakes on the company reporting side. And the sooner we can catch that and get them to update all of the forms and the reporting, the better. So I would say, yeah, keep record of anything and everything that you can. Do companies usually withhold taxes for me on the tender offer? How do I find out how much and if it was enough? So this is going to depend on how you participate in the transaction. But what I will say is a lot of times when you participate in the transaction, like you'll see if there were taxes or anything withheld from your proceeds, and then I'll give you an idea. Most of the time, tax withholding is pretty standard. So depending on what state you live in, you can Google your state and Google supplemental withholding rate, and the rate that they withhold at will pop up. Federally, they will withhold at a rate of 22%. So that's what's going to be sent to the IRS until you hit $1 million of income. And then after you hit $1 million, it goes up to 37%. But the best way to kind of see if this was enough tax withholding, I would say, is to engage with a tax professional and have them do a tax projection for you so that you know what to expect come tax filing time. And then I think I skipped over one question, which is, how do I know if the sale will be taxed as ordinary income or capital gains? And again, this is going to depend on how you participated in the offer, and then it's also going to depend on the offer to purchase. If it's not compensatory and you're selling shares that you bought over a year ago, it's likely going to be capital gain. If that doesn't apply to you, it's going to be a combination of looking at what you sold in the offer and reading through the offer to purchase to kind of try to decipher, what does this say? How does it say the transaction is being treated? And I would say in that situation, if it's high stakes, if you're going to have a lot of income from the offer, definitely worthwhile to engage with a tax professional.
Awesome. Couple last questions here. How do I figure out what my cost basis is? How is it determined? Which is a great question. Cost basis is one of the key tax figures that you need to figure out the proper reporting. And what I will say about cost basis is that depending on how you're participating in the transaction, it will influence where this transaction is reported and how it's reported. So I guess, in terms of figuring out how to report cost basis as you're thinking about reporting a sale, my answer to this would be, please talk to a tax advisor. I think that, there's just a humongous possibility of double reporting on these types of transactions for this exact reason. Cost basis during these transactions are just, financial institutions are not required to report this, and as a result can lead to a lot of misreporting on the individual tax side. So in terms of how to determine cost basis and how to make sure you're reporting correctly, I guess I will give a not great answer and say, please don't do it yourself. Please come chat with us, because again, there are a lot of nuances when it comes to tender offers. There are nuances, and we just talked about half of the equation. We just talked about non-compensatory. There's a whole world of compensatory transactions that throw even more, nuances into everything we talked about. So if you're running into this question, I highly recommend talking to a tax advisor that can really make sure the reporting is 100% accurate.
And I think our last question that we have here is, what if I've held my shares for over 5 years? Do the shares that I sell qualify for the qualified small business stock exclusion? And it depends. So if you're in this situation, the first thing that you would want to do is you would want to reach out to your company, and you would want to inquire about if they have done any due diligence related to QSBS eligibility. A lot of times companies have, or if you're reaching out and asking them about it, chances are a lot of other people are too, meaning that they likely will do something. So this is a situation where you want to ask the company, and the company will, likely do their own due diligence and can kind of give you a response on eligibility. Now, there are some cases where the company says, hey, I'm wiping my hands clean of this. I don't want anything to do with determining this. It's on you to figure it out. And if that is the case, then you would want to look at one, how big is the gain that I'm having from this, sale? If it's a large enough gain and you have kind of done your own due diligence, just at the surface level, and you think that your company is a qualified small business, could be worthwhile for you to hire someone to kind of independently try to make the determination. The one caveat there is it is going to require that the company is willing to participate in providing some information. And I would say not 100% of the time, but usually if the company says, hey, we don't want to make our own determination, but you're welcome to find someone to make a determination, the company will, give you info that's enough to at least have an outside party decide it for you. But the ideal situation is that the company's already had the determination made. The transaction is non-compensatory. You've held for 5 years and you're selling. Then you would get the $10 million exclusion. So if you have, $1 million of income from it, you're not going to pay any tax at the federal level, and that is going to be great. Now, for those of you who are in California, unfortunately, you will have California tax. Now, if you're in New York, you won't have any New York tax. Those are some big differences between California and New York. But yeah. That wraps it up, I believe, for questions on our end. Thank you so much for attending. Hope that we get to work with some of you. Also hope that your companies have tender offers this year so you can get some liquidity.
Yes, for sure. Well, yeah, thank you again for joining us for this past hour. Hope you got some nuggets and gems to carry on after this. And hopefully this also explains how nuanced and difficult this could be. So come talk to us. We're happy to help. And yeah, thank you all.